Good evening, everybody. So tonight we got Vince Vora with us. We always like to have him back because he's been training people how to trade and basically improve their trading techniques for over 3 decades now. So he's always got some very interesting and very common sense trading situations or strategies. And they're always interesting to watch. So with that, Vince, welcome back to the Candlestick Forum. We're anxious to see your information tonight.
Thank you very much, Steve. It's great to be back. Thanks for having me back on, and welcome everybody. Glad to be with you here today. Today I want to talk about options, and specifically how to crush the market with options. I've been doing this for a long time, as Steve said, and originally I started out just trading stocks. And then once I got familiar with options, it completely changed my trading around. You know, I'm sure many of you hear in the media about how risky options are. It was the same for me. But once you really get to learn the right way to trade options, you understand just how much safer they are than actually just trading stocks. So I'm really, excuse me, happy to be here and share this information with you. Thanks again, Steve. Appreciate it. Let's get started. As Steve said, I am Vince Vora. I'm the head trader here at Trading Wins, and I've been doing this for a little over 30 years. It's gone by like a flash. Been a lot of fun. But throughout that time, I have been teaching people how to trade, but I've also developed several strategies and trading systems, many of which are not only used by retail traders such as yourself now, but also several money managers and hedge funds. Now, in tonight's presentation, I'm going to start off with the true basics of options. In other words, we'll spend a few minutes on some slides talking about what a call is, what a put is, and more specifically, what the risks involved are, what the profit potential is, and how you can use them. And then talk a bit about who actually makes money in the options market and why, and how you can. And then go over a couple of different simple techniques that you can use to start trading options. Even if you're a complete beginner when it comes to options, you'll see just how simple and easy this is. And then near the end of the presentation, I'll talk about how to put everything together and really add to your options trading knowledge. Okay, and hopefully we'll have plenty of time for Q&A before we end this session. Now, options, like anything else when it comes to trading, can be risky. So please don't trade with real money until you're completely comfortable with the system that you are using. Now, let's start with the true basics, and let's start with call options. I'll read the definition first, but there's a couple of parts to this that are crucial, and then I'll give you a couple of tidbits to always keep in mind when you think of call options. So, call options, when you're the buyer, they give you the right, but not the obligation, to buy a specific stock at a fixed price, which is known as the strike price, anytime on or before that expiration date. So always think of that right that you have as a buyer. It's your choice. You're in control as the buyer. Now, on the flip side, when you're the option seller, or otherwise known as the writer, now you're no longer in control, okay? Because if the other party exercises their option, you will be obligated to sell your stock at the specified strike price, okay? And so on or before that expiration date. So always remember that for a long position on a call, your profit potential is unlimited because that underlying stock can keep rising, okay, to infinity. So your profit potential is not capped when you're long a call option. Your potential loss, though, is, and it will always be capped to the amount that you paid for that option. So it carries very little risk depending on how much you pay for that call option or that contract. All right, but you can never lose any more than what you pay for that call when you're the buyer of the option. Okay? Remember, you're in control, so you can only lose what you pay for it, but your profit is unlimited. Now, if you're the seller, or otherwise known as the writer, in other words, you're short a call, now your potential profit is limited to what you received for the sale of that call. You can never make more than what you received for selling that call in the first place. But your profit loss is now unlimited. Once again, that underlying stock can continue to rise. So your exposure is unlimited. Okay? So long call, you're in control. Short call, not so much. Okay? Remember that. Now, on the put side, the put, similar to that call, when you're the buyer, you're in control. When you're the seller, not so much. But the put gives you the right, but not the obligation, to sell a specific stock at a fixed price. Remember, the call was to buy a specific stock at a fixed price. The put gives you the right to sell a specific stock at a fixed price. Okay? Again, known as the strike price. Anytime on or before the expiration date. Now, the put seller is obligated to buy the stock from you at the specified strike price if you exercise that option. Okay? So, when it comes to the long put, potential profit, it's substantial. Okay? It's not unlimited only because the stock can't go any lower than zero. But it is substantial and increases as that underlying stock moves towards zero. Your potential loss, again, is limited to what you paid for that put. So when you're long, the only thing you can lose is what you originally paid for, nothing more. Now, when you're the seller or the writer, your profit potential is once again limited to what you received for the sale of that put, the premium that you collected when you sold it. Your loss, again, is substantial and increases as that stock moves towards zero. Okay? If it doesn't make a lot of sense right now, don't worry about it. When I bring up the option chain and talk a bit more about this, it'll become clear. Now, what is options premium? Options premium is what you pay for that contract or what you receive when you sell it. Okay? How do we calculate it? Well, one option contract is the equivalent of 100 shares of the underlying stock. So, an example, if you're buying one contract and that contract costs $1.50, what you will do is multiply the number of contracts times 100 times the 150. So in this example, your cost would be $150. If you're buying two contracts, it'd be 2 times 100 times the 150, so it costs you $300. Remember, if you're buying it, you're not going to lose any more than that, or you cannot. Okay? What type of options are out there? What can you buy and sell? Well, there's options on stocks, thousands of them actually. And nowadays, there are hundreds, if not thousands, with weekly expirations. When I first started trading, there was nothing like this. Now, the option world has really opened up. It's fantastic. You can also buy options on stock indices, like the S&P 500, for example, like the NASDAQ, the Russell 2000, for example. You can also buy them on futures, like crude oil, gold, wheat, many others, coffee, soybeans, you name it. And just about everything has an option available on it. Now, there are a few option terms that you really need to or should be familiar with. And these are terms you're going to hear quite often. Okay? In the money options. This is a call option with a strike price that's below the current market price of that underlying stock. Okay? And I'll bring up the chain in a second and show you how easily you can tell what's in the money, what's at the money, what's out of the money. For the put option, the in the money put option means you have a strike that is above the current market price of the underlying. Out of the money is the exact opposite. The call option has a strike price that is higher than the market price, and the put option has a strike price that is lower than the current market price. And the at the money is the strike price that's closest to the current price of the stock. Let me bring up my option chain here and show you for a second. So this is a typical option chain. This is Starbucks. And we've gone out to the July expiration. And here we have 85 days to expiration. Now, most option chains are laid out the same way. In other words, the column that you see here on the left side of the page, that is the call column, the call side. Here on the right side, these are the puts. Okay. Now, the shaded area here in yellow, that's the in the money portion. The white area is the out of the money portion. And the at the money is the strike that's closest to the last traded price of the stock. So the last price today was 61.30. If we look at the expirations, the strike prices here, which is right in the middle, you have 57.5, you have 60, and you have 62.5. While the closest one that we can say is at the money is the $60. So in this case, 60 would be at the money for a call. Anything below 60 would be in the money. Anything above it would be out of the money. And vice versa is true for the puts. In the money portion is the strikes that are higher than the current market price. Anything below that is out of the money. Okay? Let's carry on here. If you have any questions, by all means, type them in. And I do want to get through my slides first, but later in the presentation, I'll do my best to answer any or all of your questions. Some more option terms that you should be familiar with. There's intrinsic and extrinsic value. These two components make up the option premium price. Okay, there's two parts of it. The intrinsic is a fancy name for the in the money portion. The extrinsic is the fancy name for the out of the money portion, otherwise known as time value. So, for example, if you had a call option with a strike price of 15 and the underlying stock market or stock's price was at 25, okay, so your strike is below the market price and it's a call option. That means you're $10 in the money. Okay? And the extrinsic value is the time value portion, the difference between an options market price and its intrinsic value. Again, I'll show you on the slide when we get there. Implied volatility is a term you need to be familiar with. This is one of the most important parts of options trading. This is really what helps you understand whether a particular option option contract's price is either fairly valued, undervalued, or overvalued. Okay? So what this does is measure the volatility of the underlying security. Okay? In other words, in general, volatility will increase when the stock price is dropping and decrease when the price is going higher. Okay? The reason for that is the sense on the street is that when we're in a bearish market, there's more risk. And the reason for that is because that's when the panic sets in, right? You start getting some selling, people panic, it ends up exaggerating to the downside, okay? But the lower it goes, the higher the implied volatility will spike. In other words, the faster that drop, the higher the volatility factor. Now, when the market is going up, everyone's feeling safe, everyone's feeling confident, everything's good, no one's panicking, so that implied volatility settles down when the market's on the way up. This is going to be important when you get to making a decision on which strike you trade and whether you're going to be an option buyer or whether you're going to be an option seller. Okay? A few facts when it comes to options. First of all, they really only are risky if you don't know how to use them, okay, or how to trade them. And so I highly encourage you to really get familiar with options, because once you know how to trade them, you're going to be able to navigate the markets a lot safer and a lot more effectively. Another fact is that over 80% of all option contracts expire worthless. This is a fact, and not a myth, it is a fact. This is why it's actually better for you to be an option seller than an option buyer. And I've got a couple of slides that will really put this in perspective that I'll go over in the next couple of minutes. Now, most people, the vast majority, are only option buyers, okay? And they do so, they buy those options without taking fair value and implied volatility into consideration, mostly because they don't either know anything about it, they don't know enough about it, and so they jump in and they'll buy a call option without really being familiar with these terms. And what ends up happening is they end up buying an option that's already overpriced. So they end up losing money even though the market does move in their favor. So if you're thinking that Starbucks is going higher and you're buying a call option, if you're buying an overpriced option, you're still going to lose money more often than not, even though Starbucks does move higher just like you thought. So it's really important to understand fair value and implied volatility. So let me put this in perspective. When it comes to buying options, the underlying stock can only do one of 5 things. Okay? It can either move in your favor by a wide margin, okay? Really goes in your favor. It can move slightly in your favor. The stock can do nothing. It can kind of sit there and consolidate sideways for a while. Or it can go against you slightly, or it can go against you big time, right? Nothing else is possible. It's only one of those 5 scenarios. But now let's look at how or whether or not you would be making money under these conditions if you were an option buyer. So under the first condition, if it goes in your favor big time after buying that call option, yes, of course you'll make money. Then you should make pretty good money. If it goes slightly in your favor, you're only going to make money if you bought a fairly priced option, or better yet, an undervalued one. If you bought an overvalued option because you didn't take fair value or implied volatility into consideration, chances are you're still going to lose money, even though it goes in your favor slightly. Now, if it does nothing, goes flat, you're going to lose money. Why? Because the closer it gets to expiration, the more that time value or the extrinsic value erodes. Okay? That time value erodes a little bit each day as you get closer and closer to expiration. So if the underlying isn't moving, every day you hold on to that option, you're losing money. Now, if it goes against you when you're a buyer, you're obviously going to lose money. And if it goes against you big time, you're going to lose even more. So if you really look at this, if you don't truly understand fair value and implied volatility, you really only have a 1 in 5 chance here to make money when you're an option buyer. Okay? And it really has to move in your favor by a lot to do so. So at best, you can make money 2 out of 5 times here if you know what you're doing. Now, if you're selling options, the same 5 scenarios can take place with your underlying stock. It can move in your favor big time. It can move slightly in your favor. It can consolidate sideways. It can go against you slightly or go against you big time. But now if you're an option seller and it moves in your favor big time, you're going to make money. If it moves in your favor slightly, you're still going to make money. If it moves sideways, you're still going to make money. Why? Remember, you're an option seller. So as it gets closer and closer to expiration, the time value is eroding a little bit each day. Right? Since you sold that, you're looking to buy it back at a lower price. So as it erodes, you're actually making money. Even if it goes against you slightly, you're still going to make money on this, okay? Because of that time erosion factor. And I'll explain a little more when we get to the tables. The only way you're going to lose money when you're selling an option is if it moves against you in a big way. So now the probabilities have flipped. And now we have a 4 out of 5 chance to make money selling options. Now, if you have the right strategy, the right money management plan, you can still do very well buying options. It's mostly what I do. Okay? Even though you see the odds here, and I'm teaching you that selling options gives you a much higher probability of making money trading options, it's still something you have to be very comfortable with. It's something that you have to wrap your head around. And psychologically, it's very difficult for some people to wrap their head around this. Because here, you may be making money 4 out of 5 times. But remember, as an option seller, your profit is limited to what you collect, to the premium you collect when you sell that. So your profits aren't going to be very high. You're just going to be very consistent with your wins. But if you don't control your losses, when you do lose 1 out of 5 times, it could quickly eat up your profits. Okay? So you still need a strategy, you still need a proper money management plan to do this. Okay? But once you grasp this and you truly understand what's possible with options, and better yet, when it's appropriate to buy and when it's appropriate to sell, then everything kind of comes together. Okay? Now, this is my last slide before we get to the charts. And this is just a table showing how the pace at which that time value portion or the extrinsic value portion of the option erodes. Okay? How quickly that time value erodes. If you look down here, these are the number of days to expiration. So when you have a long time to expiration, that erosion happens very, very slowly. But as you get closer to those final 30 days, that's when it starts to accelerate. And 30 days to day 0 here is when it really accelerates and starts eroding. So if you're an option buyer, you want to buy time. That way, after you buy it, if there's a period of time where your stock goes silent or consolidates for a little while, you're not going to lose much on that time erosion. Okay? And the longer you have, the slower this will erode. Okay? But of course you have to balance this with the cost. So you don't want to go too far out and be spending a lot of money on an option trade. But on the flip side, if you're a seller, you want that time erosion to happen very quickly. So you want to sell options that have 30 days or less to expiration. Maximum you can go 40. I wouldn't go anywhere above 40 days to expiration when I'm selling an option. But 30 days or less is preferred because that time value will erode very, very quickly. So if you sell that option and the underlying stock consolidates, you're still going to make money very quickly here. Okay? So now let's talk about option strategies and how you can trade these effectively. Now there's dozens of strategies. We're not going to have time to go through these all. I'm going to go through a couple, but you can buy calls and puts. You can buy protective puts, especially if you're marrying them with a stock. Very effective, and I'll talk a bit about that tonight. You can do spreads, and there's all sorts of spreads. There's debit spreads, there's credit spreads, there's calendar spreads. You name it, there's straddles, strangles. And then the more sophisticated strategies that sound overly complicated, but once again, when you really learn how to trade options, they're not complicated at all. And these are the butterfly spreads, the iron condors, the collars, etc. The key, though, as I mentioned earlier, is to know when and how to use each one. But more importantly, what you need to understand at this stage is that you don't need to trade them all. You only need to trade the ones that make you money. In other words, get comfortable with 1 or 2 of these, really understand them well, learn how to trade them, and then when you're consistently making money with them, move on to another strategy and add that notch to your belt, right? Slowly learn a new strategy as you go through. Let's talk about the first one. A simple and easy way to buy some calls and make some money, or how to just trade with options around the stock. Okay, I'm going to show you how you can buy Starbucks here for less than a cup of coffee. Actually, a lot less. How many of you have been to Starbucks lately? You know exactly what a cup of coffee costs. Now, here's Starbucks. Let's look at excuse me. Let's look at this. Now, it's had a real nice run lately, right? And this run will come in handy in the next strategy that I show you. But let's say we thought Starbucks was going to continue to go higher. Okay? Let's say, there's a certain pattern here, charting pattern or candlestick pattern that we really like and is bullish and we think it's going to go higher. So we're going to go to the option chain. Now, if we're trading on a daily chart, okay, and we're going to be buying an option, you want to buy at least 60 to 90 days out, preferably 90 days. Why? Because remember, we don't want to be buying an option, we don't want to be long an option if there's 30 days or less to expiration, because that's when the time value really erodes quickly. So if we buy an option that's 85 days to expiration, like the July expiry, okay, we want to be out of that trade when there's 30 days, when we get to the point where there's 30 days left to expiration. So we really only have 55 days for our position to move in our favor before we want to be out of that position. If we're going to trade, say, on a weekly chart, let's say we like to do things a little longer term, and this one's pretty bullish right now, but we want to sit in it for several weeks, then we want to extend our expiration date. We want to go out, say, to October, okay? Go out about 6 months. If we're going to trade on the monthly time frame, we want to go to the leaps, okay? Say go to Jan 18 or June of 2018, all right? That way we have enough time for that stock to move and make us money. Always remember, if you're a seller, you want 30 days or less. If you're a buyer, you want to buy time. Now, let's say you're day trading this. 5-minute, 15-minute, even an hourly chart, a 4-hour chart, then you can go lower. Shorten your expiration date. If you're trading on a 5-minute chart, you can use a weekly, easily. 8 days to expiration, because you're only going to be in that trade either a few hours within the same day, or maybe if you plan to hold overnight, you're in it for a day and a half or something. But really, you don't have to worry too much about time erosion if you're going to be in that trade for 2 to 3 hours, right? Make sense? So now, let's say we're bullish on Starbucks, and so we want to go long. We could simply buy the stock for $61.30, right? Or we can buy a call option. Now, if we're buying a call option, we can go in the money, and the only reason you'd want to go in the money is if you expected a smaller move. In other words, this is a balance between what you're paying for that option contract, and in other words, the amount of risk you're taking, because remember, you can't lose any more than what you paid, but you certainly can lose what you pay. So let's say that from 61.30 here, we expected this to move to 65, let's say. Let's say it's a 4-point move that we're expecting in the underlying stock. Okay? Well, if we're in the money, that means that we're gonna actually make more money over those next $4 move than we would if it was out of the money. And this has to do with delta, and I'm not going to go too far into this because we're getting ahead of ourselves here. But the delta is a measure of how much your option will move compared to every dollar move in the underlying. So if you look at the 57.5 strike, which is in the money, and you look at the delta, it's got a 58 delta. That means for every dollar that Starbucks moves higher, you should gain about 58 cents in this option, on this option. Okay? If we go with the 62.5 strike, which is out of the money, it's going to cost us less. Look, this one was going to cost us about $4.50 or so. This one's going to cost us $1.50. But look at the delta, 24 cents. So that means for every dollar Starbucks moves higher, we're going to make about 24 cents. Now that number increases as the stock moves higher. Okay? But still, if you're expecting a smaller move, you go with the higher delta. That way you can maximize your profit over that small run. If it's a larger move, you want to go out of the money. That way you can afford to buy more contracts. And if it actually does make that bigger move, by the time that move completes, this delta figure will be much higher. In the end, you'll make a lot more money. Okay? So definitely something to keep in mind. Now, the other way you can do this is to marry a put option with the stock. And especially if you're managing a retirement account or just love to trade on a weekly or a monthly time frame, you can really maximize your profit over that run by marrying options with your stock. So let's say we're going to buy Starbucks. We want to hold this for several years because we think it's a great company. It's going to continue to make money. It's going to continue to go higher. We buy it at 61.30. What we can do is buy a put so that we can lock in our risk factor. So let's look at the 62.5 here for July. If we pay 61.30 for the stock and we go out and pay, say, let's round this off and say we pay about 270 for this option. That means we're actually dishing out 61.30 plus 270, right? So the total is $64 that we're spending. But as the put buyer, we always have the right, not the obligation, but the right to exercise that option and sell our stock at our strike price, which is $62.50. So if we paid 64 and we have the right, the right to always sell it at any time on or before the expiration date, we can sell it at $62.50. And our risk is only $1.50, the difference between 64 and 62.5. That's our max risk, is $1.50 over the next 85 days. And it doesn't matter if the stock goes to 0, okay, or if the stock goes to 300, we always have that right. Now, if at expiration it's below 62.50, of course we're going to exercise and sell at 62.50. Why would we sell it at a lower price and take a bigger loss? Now, if this is substantially higher, as the price goes higher, our option price will drop. The value of our option contract will drop because it's a put. Okay? So as the stock price goes up, this goes down. But the delta on these, the difference, the net delta, is about a 40 delta. Remember, the stock has 100 delta. For every dollar the stock moves, we make a dollar. For every dollar it moves, we're going to lose about 60 cents or so, 63 cents here. So we're going to be net 40 cents. And as this goes higher, this delta diminishes. So on the first dollar, we're going to make about 40 cents. On the second dollar, we'll make more than that. On the third, we'll make even more, etc. Okay? But now, imagine if you had a stock that paid a healthy dividend that you were happy holding longer term, okay? And you can lock in your risk factor like that. Now you can just hold it, collect that dividend, wait for that stock to make its move, okay? And if something goes wrong, you know exactly what your loss is and can get out of it, all right? And the beautiful thing about options, as we like to say, is you have a lot of options with options. In other words, there's so much you can do. I'm barely scratching the surface here tonight with what you can do. Because the thing about holding the stock and the options together, you have so many choices. Along the way, picture this. You buy the stock. Let's say we bought it down here and we bought a put with it, so we locked in our risk. But our upside was unlimited, uncapped. Now this thing makes a move. And then suddenly, you see some sort of bearish candlestick pattern. And if you're following Steve's a master at candlesticks. I'm sure you've learned quite a bit from him. You'll be able to recognize that turning point. So at that point, you can actually sell a call against your position. It'll be a covered call. You're actually bringing in premium there. Okay? As it pulls back, you're making money on that call. Now, when it turns and gives you a bullish signal, like this bullish engulfing pattern right in here, that's when you close out your call, you buy it at a lower price than what it was sold for, you pocket that money, and you can continue to hold that stock along with that put and continue to bring in dividends and have your stock appreciate, right? The other thing you can do is as the stock moves higher, let's say this option was almost worthless now because the stock moved up so high. You can roll it up. You can buy another higher strike here. By that point, these will be a lot cheaper. And you can move up your strike and continue to lock in profits as you go. Okay, so it's sort of like a trailing stop, but you can sleep soundly at night because if there's any huge gap against you at any point or whatever, you always have the right to sell this at that price, no matter what. Okay? So options are awesome that way. Now, let's talk let's get in one more here and talk about trading them around earnings season. Okay? Trading earnings season that we're in right now can be very profitable. The problem is most people trade them the wrong way. So earlier today, after the market closed, we had huge earnings releases, Amazon, Google, you name it, huge beats and big gaps after market. We should see big gaps tomorrow morning on those stocks. Now, a number of people would go in and buy a call, for example, this morning in anticipation of, hey, hopefully it's going to gap higher tomorrow. Even though they're right, even though Amazon, Google are going to gap up, they'll probably lose money, and here's why. It goes back to that implied volatility feature that I talked about earlier. Now, if you're a thinkorswim user, they make it very easy. If you look on the far right here, these percentages, here when you collapse your option chain, this is the implied volatility figure. Okay? Now, for each expiration, there's an implied volatility figure. Now, for most stocks, when you collapse them all and you look down this row, you're going to see a range, an average. And you can see here on Starbucks, it's the low 20s. Most of these are in the low 20s. So that's the average for Starbucks, and that's what you can expect. So when you see one like this today, 69.89, obviously it's inflated. It's very high. If you were to buy one of those options, then what does that mean? It means you're overpaying. You're buying an inflated option. Now, why was it inflated? Because earnings were today, and this is the last day of expiration, and you know all the hype, etc. There's 1 day left to expiration. It expires tomorrow, and so these were. We saw an implied volatility spike because of that earnings event coming up, the build-up to that earnings event. Now, I'm going to show you a couple of other examples here, and you go down the list. There are many out there. Look at Expedia, 106% the implied volatility, when the average is around 30. Okay? So, if we had gone in and bought a call today just before market close, waiting for EXPE to come out with earnings after market, and let's say that we were right, they beat, and tomorrow they gap higher. But tomorrow, when this option opens up, you're going to see what's known as an implied volatility crush happen. In other words, after that announcement is made, the implied volatility will fall back in line with the average. Throughout the first hour, hour and a half or so of trading, you're going to see this go from 106 quickly down. It'll probably open at like 50 or 40 and then slowly come in line with about 30. So in other words, let's say you had paid $10 for your option, okay? And it went from 106 down to 30. What does that mean? You're losing 70% of your option. That option is immediately going to go from $10 to $3, right? So that gap has to be enormous for you to ever have a chance at making money. So the best way to treat this is to identify that earnings date, that upcoming earnings date, and identify a number of stocks that tend to move well and tend to move into earnings. So if we look at, for example, Apple, okay, see this earnings announcement right in here, January 30th? That's when earnings was, and it gapped higher. Now, if we had bought a call option that day, the implied volatility on that would have been very high. And so even though it gapped higher, chances are we would have lost money. But if we mark that date on our calendar ahead of time, and then 2, maybe 3 weeks before, we look for potential setups. This is how this would work. Look, right in here, it's one of my favorites, a bullish engulfing pattern. Let me zoom in. And actually, let me redraw that because I covered 3 candles. Should be covering 2. Right in here. Okay? Now, whether you want a hammer candle, bullish engulfing, whether you have some other indicator that you use, it doesn't matter the strategy or the candlestick formation. It's just you're identifying an entry point, a valid entry point that you know is consistent, you can rely on, and it's far enough ahead of earnings that the option chain has not started to appreciate yet. We haven't seen that implied volatility spike yet. Okay? So we get into this trade. Now what happens as we start moving in? Okay? The implied volatility starts to spike higher, which increases the premium of the option. So even if this were to go sideways, the premium would increase. So a trade like this is much safer than a normal trade because it doesn't necessarily have to move big time in your favor for it to make money. Because as the implied volatility spikes, the value of that option increases. Okay? So now, if you do get a nice spike in your favor, it's even better because the higher it goes and the faster it moves, the greater the implied volatility spike and the more money you're going to make. If it gently goes higher, you're still going to make money. If it goes sideways, you're still going to make money. And you know what? Even if it goes against you, you're not going to lose as much as you would because as you get closer and closer to that earnings date, the implied volatility spikes and the price goes higher, which offsets some of that loss that would have happened if there wasn't an earnings announcement coming up. Okay? So the plan is to buy ahead of time. You can start looking as far as a month ahead, but usually within the last 2 weeks ahead of the earnings announcement is when you see that implied volatility spike. But you can start looking for the setup up to a month before and plan to be in that trade, but plan to get out of that trade before the earnings announcement. Okay? Or, you know, if you have a nice profit, take a good portion of it off and maybe leave a contract or two hoping that it pops in your favor. By that point, you know, you would have made money no matter what. So both are fantastic. So there's a lot of ways to trade options, a lot you can do with them. And again, we haven't even scratched the surface. When you're talking about combining them and putting on spreads and getting into the more sophisticated strategies, then you're talking about really leveraging options and really giving yourself an opportunity to not just make gains, but make explosive gains without taking all the risk. That's the real key here. That's what I really love about options, is the fact that once you know how to trade them, you can do so safely. So you can give yourself the opportunity to make a lot of money without taking a lot of risk. And you know exactly when you're in control and when you're not, you know, depending on whether you're a buyer or a seller. Now, to put this all together and to build on this, we've put together a fantastic package here. And this is something we haven't done before, but we wanted to do something special coming on here, being welcomed back by Steve. We wanted to do something special for his people. So in this package, first of all, if you go to tradingwins.com/ready, that'll take you to this page that details everything in this package. And I want to go through all these items for you. First of all, it's an on-demand training course. It's about 2.5 hours long. And in this course, not only do I expand in a lot more detail on what we covered today, but I'm going to show you a way to create a steady weekly income using credit spreads. Remember, a safe way of doing this. I'm extremely conservative, so you're not going to see any crazy aggressive strategies from me. This is a safe way to make a consistent income using weekly spreads. Also, the butterfly strategy, butterfly spreads. Butterfly spreads, normally, the reward to risk is about 10 to 1. In other words, you're risking 1 to make 10. These are explosive. These are fantastic. And again, I'll show you an easy way to trade these. And even around the earnings season, believe it or not, it's quite great. Also, for those times when the market is going sideways, and if you look at a chart of the Dow or the S&P, there's usually 2 or 3 periods in the year where for a couple months at a time it kind of goes flat. I'll share with you a couple of different delta neutral strategies that allow you to make money either way. No matter which way the market moves, and if it stays quiet, you're going to make some money. And more importantly, how to repair trades that go wrong. This is one of the most important parts of the class, and especially for those of you just starting. Now, you really should be familiar with repair strategies, because as a beginner, you're going to take more losses now than you will later on when you're more experienced. So the repair strategies are actually extremely important right now at this point in your trading. A lot of excuse me, a lot of traders start off and they think, well, as I get more experience, then I'll dive into the repair strategies. No, you should actually know your repair strategies now. Now, along with this, we're going to throw in not 1, not 2, but 3 months of our pro membership, our pro trading service with this. Okay. Now, there's no automatic renewal here. We heard from a lot of you who don't like the automatic renewals. We've removed that, and we're giving you 3 months of membership here for a specific reason. So you're not alone, so you have the opportunity to learn this. Ask me anything you want along the way. Have me help you go from a complete beginner to an experienced option trader. What's involved with the membership is 5 times a week, every Sunday to Thursday, I send you videos recapping what happened that night in the markets and sharing trades that I'm looking at from all our different strategies. Now, we also answer member questions through there sometimes, but more often than not, what we do is answer them in our live market chats. We have these twice a week. Every Monday evening and every Thursday morning, you get to come into our live room and ask me any trading related question you like, whether it's on options or any other part of your trading that you're struggling with, and I'm there to help walk you through it. All those sessions are recorded. So you're going to get 8 separate recordings per month that go into your own personal video library, along with the recording of this options pro training class, okay? And also our course of the month. Every month we do a new course for members at no extra charge, no extra cost every month. The next one is coming up this coming Friday, next Friday, not tomorrow, a week tomorrow, 10 a.m. Eastern, and is going to be on day trading. Okay, I'm going to share that with you. You'll not only be able to attend that live, but it's recorded. So if you can't attend live, you'll get the recording there as well. And we're going to throw in a completely separate course, Magic of Ichimoku, which is a class on how to trade the Ichimoku Kinko Hyo indicator, a very effective indicator that's been very popular over in Asia for many years and has become a lot more popular in North America over the past few years. It can be used as a strategy in itself, or as I use it, a very effective tool to help you identify trend very quickly. We're going to throw that in as well. This is all for a one-time payment. Again, no automatic renewal whatsoever. No extra cost. It's a one-time payment of $247. The link here is tradingwins.com/ready. And I believe it's in the chat box as well. You can click from there. Now, I'd be happy to answer any questions that you have with the time that's remaining here. I'm just going to take a quick sip of my water, and then we'll get to some questions. Rick has a question. He's saying the extrinsic value is the only part of the price of a contract affected by the implied volatility under time. Actually, you're partly correct. That is the only part affected by time, really, not implied volatility. Even the intrinsic portion is affected by the implied volatility. But the time factor, the extrinsic value, is the time value portion, or the out of the money value portion of that contract. So as you get closer to expiration, that will erode. I want to quickly bring up the option chain again and explain that in a little more detail. Okay, so let's look at Apple, and let's look at the Julys again here. Now let's look at the 140 strike. Apple closed at 143.79 today. Okay, for round math, let's just say 143.80. Okay, so if our strike is 140, okay, and the stock price is 143.79, in the money portion, or the intrinsic value portion, is the 379, right? 140 here, and the stock is worth 143.79. So if today was expiration, this call option, the 140 strike, would be worth $3.79 because we ran out of time, right? Expiration's today. There's no more time value on it. So the difference between that $3.79 and the $7 that you see that it's worth today, the difference, okay, those extra $3.30 or 20 cents, whatever it is there, that's the time value portion. It's worth that because this still has 85 days to expiration. So as you get closer and closer to the expiration date, the time value will erode. So if the stock stays, it doesn't move and stays at 143.79, it'll slowly start dwindling down towards the 379 price that it would end up with if this was expiration. I hope that's clear for everyone. Okay. There's another question about the delta. So when buying long call, do you usually go for near 70 delta? If I'm going in the money, yes, I will go towards 70. Again, the way I look at it is I look at how big of a move am I expecting on this stock. So if we look at Apple here, you know, an easy way to do it is identify your next level of resistance, overhead resistance. So let's say our overhead resistance came in at 148 and we're sitting around 144. Again, we have another $4 move there. So if I'm doing a 70 delta on a $4 move, I'm still making good money because it's 70 cents for every dollar minimum that it's going to appreciate. I'm looking at a healthy gain. If I go on and take a 20 delta on that, my profit's going to be a lot less. Now, if I'm expecting a big move, I would go for the 20-25 delta because it's going to cost a lot less. Okay? Look, the 70 delta here, it's actually 76, but it's going to cost you over 10 bucks a contract. The 20 delta, or the 19 here, it's going to cost you a little over $1. So you can buy almost 10 times the number of contracts. So if it ends up making a big move and going to 155 from 143, you're going to end up making a lot more money with more contracts. But it's really a balance between the amount of time to expiration, the amount of risk you want to take, and by that I mean cost. Because remember, there's one thing you will never get around with options, and that's a gap against you, right? The stock can gap against you anytime. So it's the price you pay that is the max loss you can take. So only go with what you're comfortable with losing, okay? Enos is saying when you buy an option, they also have someone selling an options. So, well, yes, there is a seller for every buyer. That's right. Most of the clearing is done on a first in, first out basis. You don't need to worry about who the other person is on the other side. All you need to worry about is if you're a seller, you know that you can be called away at any time on that contract. The other party can exercise at any time. Now, they only will do that if it makes sense. In other words, if you're short a call at 140 and the stock moves above 140, then yes, you're at risk of being called away. If it's below 140, why would anyone call it away and buy your stock at 140 when they can go out to the open market and pick it up for 130 or 135, right? Why would they want to pay more? So they're only going to exercise it if it makes sense. Okay. We have a few minutes left. Let's see if there's anything else. And let me actually repeat the offer before we sign off here. Let me just bring it up one more time. There's a lot in this. So again, the link is tradingwins.com/ready. And in this package, what you're getting is the pro training session on Crush the Market with Options, which is a 2.5-hour training course on demand. You can watch it from anywhere that you have an internet connection. This goes in your personal video library. In that class, we go through the basics again in greater detail, but then I get into the specific strategies. One of them is credit spreads and how you can create a steady weekly income using credit spreads, safely that is. Then I'm going to show you the butterfly spread strategy where you're only risking like $90 to make 1,000. Remember the reward to risk here is 10 to 1, usually the way we do it. And for those times in the markets that you're not quite sure which way it's going to move, or they're just consolidating sideways, we're going to give you a couple of different delta neutral strategies so you can still make money while you wait for that market to break out. Also, repair strategies, absolutely crucial. And give you a couple of great ones here to use, so when a trade goes bad on you, you can turn it around. You get 3 months, 3 full months of our pro membership, which again gets you the nightly videos, gets you the 2 live market chats every week, and gets you the course of the month. Also thrown in at no extra charge, and you get recordings of everything. You get our whole separate course on the magic of Ichimoku indicator, and all of this for $247. And this is a one-time payment. Nothing will auto-renew here. If you want to continue with us at the end of the 3-month period, you give us a call, and we'll set you up. Okay. So again, with options, you have a lot of options. That's the best part of this, and you can trade very, very safely when you know what you're doing. So I really hope you start your journey down the road of learning how to trade with options, because it really will change the way you trade and really will make you a much more consistent and profitable trader. And I hope you do it along with us here. Remember, it's tradingwins.com/ready, and that's the package. Before I sign off, I do want to say a huge thank you to Stephen Bigelow and his team for bringing me back on. I really, really do appreciate it. It's been great to be on again here, and I'd love to do it again next time. With that, I'll turn it back to our host. Thank you very much.
Thank you very much, Vince. Good information. So everybody take a look at the link. Once again, you're probably going to get a lot more value than what you expect using Vince's information. So with that, everybody have a good evening. We will see you bright and early in the chat rooms. Vince, once again, thank you. Good stuff.
Thank you.